Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good day. Ira Epstein of Linn Associates with your agriculture update for this Thursday, the first day of February 2018, and right now we're getting into the 4:40 time frame. As you can see, down in the wheat and the soybeans, corn pretty close to unchanged to a small gain. We're still looking at bonds and notes putting pressure, if you will, on higher rates. Apple's earnings just came out. They weren't all that stellar, and we went from about up 30 to down 30 at these last quotes. You will close higher than this because the settlement's determined at 315, and here we are at, 340 in the afternoon or so, 350. But the concept is, at least, the market backed off after the Apple earnings. So that has nothing to do with grains, but it does affect everything as a whole. As you can see, you've gone from 947 on a closing basis to a high of 985.5, and you backed off a little bit today, about a half a cent from that. The market is still over the 18-week moving average of closes, so it still has bias, but this area right up here, this whole area near $10, proving to be a bit challenging at this point. As you can see, the market did break back, and the last break low right here is the one that you keep your eye on, and that low was 985.5. What did you do today? You came back under it. So what I will be doing is I will be saying this market has now entered a down thrust, and it has to get back over that number in order to say that we've got a pattern where the market is continuing to make, on a closing basis only, higher lows and higher highs. Yes, the overall bias is up because you're over the 18-day moving average of closes, but the market got hurt today, and you could see that on this chart. For those of you that are subscribers to my research, you know that I said that if this market gets under the 983.25 zone, there could be a problem. That had to be the number the market was defending, and the real telltale wasn't beans as much as meal. It just refused to join in to the parade on the upside. Very difficult to get a bean bull market without meal. In any case, when we put the swing line on this chart, we have a clear-cut higher high, lower low pattern. No trend coming on the market. When we look at where the market fell to, come on, I laugh sometimes when I see this. I had told you yesterday that the first stopping spot is often when you're above an 18-day average, back to it. If it gives ground, you could go to, if you have the 18-day under that, the next number, that 18-day average of closes. Well, today's low 77.5, the 18-day average 77.5, you hit it and you bounced. That's all that you can say. So now the resistance becomes the 88.25 area. We also have Bollinger Band tops, which really didn't do a great job of stopping this rally. The market got easily over them, punched through them here, and now we can see that the market on this pullback, expect to see the Bollinger Bands start to come down like that and the bottom one come up. The market is exited what I call a vertical price rise, and so many of the markets did it. Financial markets did it. The stock market just did it. They've ended those rises that we had literally beginning in early January and kicking up to the very end of January. So the month of January, vertical rise that also ended it. When we come to the slow stochastics momentum, it turned down today. So what we have now is a market that has lost its way to the upside. It's not trending. It is still have some upside bias because it's over the 18-day moving average of closes. Momentum is pointing down, but you've already hit the objective that the momentum calls for. This is a chart that probably has to do some rebuilding. In the meal market, you have a pattern of a higher high, lower low. I am still looking for the loss of the embedded reading, which took place literally right here. This was Thursday's action, And as you can see, both numbers were still over 80. You lost it on Friday, which puts into play the 18-day average. Now, admittedly, as each day goes by, especially when you had a vertical price rise, the moving averages will climb a little bit. See what's happening right here? Even though you've lost that embedded reading, price and the 18-day average try to come together. You can see yesterday, you'd have said, Ira, now you're not right. And today you're going, oh, he looks pretty accurate on what he was saying in terms of, yeah, they stand a good chance of coming together. All I can tell you are what the odds are. I cannot tell you it's going to do it. I don't walk on water. I don't know. But what charting is about is anticipating and working with events off of formations that have a better chance of working than they don't. And when you watch what slow stochastics do, often momentum leads price, and that is what's going on right here. In the soybean oil, as they're unwinding the meal oil spreads because meal's getting weaker, yes, it's providing a small bid to the soybean oil. It's got support here at 32.85. Should it take out 32.62, it loses its shot at an uptrend. So what I think's going on is some traders are buying this on the pullbacks. Now, you had an outside day down, which really doesn't speak well for the market. We'll see if it can do better tomorrow. In the corn market, we had a day up, and the market today, what about yesterday's high? That's what I look at. Did it take that out? No, it equaled yesterday's high. So we had a lower low, higher high day, and you have an embedded reading. So this means on the pullbacks, this market is still very much in the bull camp. What makes a bull reading here? Well, if you'll notice, both numbers are over 90. Day before, they're over 90, and the day before. Day before, they're both over 80. The key is 80, not 90. As long as both numbers are over 80, and they do so in several days or more, they're embedded. And when the red line gets under 80 on a closing basis, you look for momentum to come out and for prices to potentially fall back, and you look at where the key averages are, because the 100-day average is the closest average. That's the number I'd be looking at as first support if that gives ground. The other average, the 18-day. Right now, the target is 363.25, the upper Bollinger Band. In the wheat market, you are trying to embed. Both numbers are over 80 today. Yesterday, both numbers were over 80. The day before, over 80, not the day before. So we have our 3 days on further pullback. I would say that the pros are probably going to nibble at 442.25 and maybe again at 433.25. But the trend has turned in their favor unless the red line closes back under 80. In the sugar market, since you lost the embedded reading right here, I have been looking for price and the 18-day average to come together. Haven't changed my opinion, but because it has taken so long, I doubt that the rally will have a lot of steam to the upside. In the coffee market, you have a higher high, lower low. I'll call that no trend. Momentum is down. Bias is down since you're under the 18-day average. A near-term target might be that lower Bollinger Band. If the market decides to rally instead, I'd look at the 18-day average as resistance. The problem with the market is there's no trend. You're just sort of waffling back and forth. In the cocoa market, once again, we still have maintained, we did it without today's action. We've had the higher highs, higher lows, right back into the 100-day and the upper Bollinger Band. It is overbought. Is this enough to propel the market to another leg? Well, let me put it this way. There's nothing bearish on the chart other than the market is overbought. Is there a reason to be short? I don't see one other than there's a reason maybe to take longs off up here. That I can agree with, but there is no reason to be short this market. In the cotton market, as I said yesterday, you got close enough breaking from up here, this upper Bollinger Band, right just missing the lower one, and it's what I said yesterday. I don't think you had to go much further on the downside. You didn't have to hit that number. I will be surprised if you don't get up to that 18-day average of closes. The problem is if you wanted to sell it, you're not wrong unless you get over 82.85. That's too big of a risk, and you're oversold. Is there a reason to be a buyer? None. In the cattle market, what did we say yesterday? Let's go to yesterday's action. I said that this market could turn down if you take out this low. Therefore, the bulls have to support the market right here. What I don't like on the market is it's overbought. If it takes out this low, this first arrow, then the risk would be back up here, would be a $1,000 risk. So it's too much to take anyways if it got down there. But if the bulls are going to make their stand, they make it here. And the bulls made their stand, and you can see that. You are still overbought, but in an uptrend. In the feeder cattle, this is yesterday's action. If you're going to get bearish, and I was looking that if this market got under the 14500, I thought the bears would show up. That means the bulls have to support the market before it gets under that. This is today's action. Didn't even try to go the other way, right back to the upper Bollinger Band. So when you chart, my point is think ahead. The what-if scenarios. Doesn't mean they're going to happen, but those are the what-if scenarios. Last, in the hog market, I don't like the idea of getting short into a 100-day average and a lower Bollinger Band on the first challenge. Will the market embed? Well, as you can see here, both numbers are under 20. The day before, they're not. Tomorrow will tell us a lot more. The problem that we're having in hogs and what's hurting the market is there's a lot of concern about U.S. export business. Is it going to hold up with NAFTA if it goes away? Traders are getting concerned with that. Let's talk about something that I think can help you out, and it's Modern Trader Magazine. Yep, 1 year free subscription. No, it's not the $79 you'll have to pay if you go to their website and you want to sign up for it. Rather, it's free through us to them. And yes, all these cool stories. So if we take a look, you're going to see, will the dollar rebound in 2018? NTGR gearing for a breakout. Well, did it happen? I don't know. They wrote this, and they're already getting ready with their March issue. Delphi Automotive. Crude and coffee reversals. What's going on there? ETFs. I can go on and on with all the cool stories. This comes out every month. Then to back it up, and by the way, the stories are phenomenal, especially these and the bump and run strategy and some of the others about stochastics. But my point is, daily you also get market focus. You get another source of information about, written for, and contributed by people in our business talking about what's going on in the market. So if you'd like to see it, it comes by email, free to you through us. Just simply call us, go to our website. You can sign up for it that way. Click up here if you're watching me on YouTube, or underneath us in many websites it says click here for Ira's free information. Enjoy your day. I'm Ira Epstein.